Welcome to the Deep Dive, the place where we really try to cut through the noise of financial reports and corporate news to give you the signal.
Exactly.
And we've got quite a stack of results today, actually, from the world of specialty chemicals, specifically the latest financial releases from Vishnu Chemicals Limited, you know, VCL.
Yeah, and this is exactly the kind of material we love to dive into. Because VCLs, well, they're unaudited, consolidated, and standalone results for Q2 and the half-year ending September 30, 2025.
So that's Q2 FY26 and H1 FY26.
Right, exactly. They didn't just show growth. I mean, they showed some really strong strategic execution on, well, multiple fronts.
Okay, let's unpack this then. Our mission today, really, is to understand how a global chemical player like VCL hits what looks like a rare trifecta of success this quarter. The headlines alone are pretty eye-popping, honestly. They really set the stage for what we need to talk about.
They absolutely do. We're looking at three simultaneous and frankly massive achievements defining this quarter. First off, VCL officially passed that really significant financial landmark. Over 1,000 crore in net worth.
Wow, okay, 1 billion rupees net worth, that's big. What's number two?
Second, they hit a new all-time record quarterly revenue. For the first time ever, they broke the 400 crore mark in a single quarter.
400 crore revenue, okay.
Yeah.
And the third one, you said it was more operational.
Yeah, the third achievement is purely operational, but maybe, just maybe, the most crucial for their long-term strategic growth. The successful commissioning of a major new specialty chemical plant.
Ah, okay. So this isn't just scaling up existing stuff. This is real diversification.
It absolutely is. And maybe before we dive into the metrics, let's just quickly set the stage for you, the listener. VCL, they're a leading global player, right? Highly specialized in these core industrial chemicals.
Or chromium and barium compounds, mainly.
Exactly. Chromium and barium chemicals. Think pigments for paint, specialized catalysts, leather tanning, making fine glass, essential stuff for heavy industry. And they serve over 50 countries. So the global reach is definitely there.
Right, 50 countries. Okay, let's start with that consolidated financial picture then from Q2 FY26. Because like you said, the numbers here tell a story not just of growth, but efficiency too.
That's the key distinction, I think. So on the top line, operating revenues climbed to 401.1 crore. Now that's a very solid 16.7% increase year over year.
Okay, 16.7% up from, what was it, Q2 last year?
343.8 crore in Q2 FY25. So yeah, a really decent increase in sheer scale.
But here's where it gets really interesting, isn't it? The part that separates, just good performance from genuinely outstanding performance. The profitability gains seem to have dramatically outpaced that revenue growth.
That's the critical mechanism we need to look at. You've got EBITDA, that's earnings before interest, tax, depreciation, and amortization, basically the company's operating cash flow. That surged 28.8% year over year, hit 58.2 crore. But look at the bottom line. Profit after tax, PAT, the actual profit for shareholders.
And that PAT saw the most dramatic increase, didn't it? Up, what was it, 44.0% year over year? Climbing to 32.8 crore.
Exactly, 44%.
So, okay, revenue up about 17%, let's say, and profit up 44%. How does that happen? What explains that huge delta?
Well, that's the smoking gun for operational leverage, right?
Yeah.
When your revenue increases, but your profit increases nearly 3 times faster, it signals a successful mix of things. One, you're leveraging your fixed costs better.
Okay, meaning new sales don't cost as much in overhead.
Precisely. 2, you've likely got successful cost management happening across the board. And 3, and this is critical, you probably achieved some decent pricing power.
Meaning the prices VCL charged went up more than their raw material costs.
Or at least held firm while costs were managed, yeah. This 44% jump, it strongly suggests the whole operational strategy is, well, it's clicking, it's really working.
And that efficiency story, it shows up in the margins too, right?
It does, yeah.
Yep.
We saw robust margin improvement. The EBITDA margin improved by 137 basis points year over year. Reached 14.5%.
Okay, 1.4% improvement, roughly.
Now, it's fair to point out the sources do note that the margins softened just slightly sequentially compared to Q1 FY26.
Ah, okay, wait. So if the margin softened a bit from Q1, should we be worried? Like, is that short-term demand or pricing pressure? Or is there another reason?
That's a sharp question. Look, in the commodity and specialty chemical space, sequential ups and downs are pretty common. Input costs bounce around. Sometimes there are temporary inventory things.
Right.
However, The year-over-year comparison, that's usually the better indicator of fundamental health. And that 137 basis point improvement year on year, it suggests that structurally, VCL is stronger than it was 12 months ago. They seem to be winning the long game on efficiency.
Okay.
And the gross margin also improved, 32 basis points YoY, up to 43.1%. That confirms that their cost of goods sold is being managed pretty effectively too.
So we've got scale, we've got high profitability, improving margins, but all of that needs a really solid foundation, right?
Yeah.
Especially when you're pouring capital into commissioning a big new plant. How's the balance sheet look?
The balance sheet looks disciplined, robust, really. Despite all the capital expenditure, the Capex tied to that new facility, they kept a remarkably low debt-to-equity ratio, just 0.41.
0.41 DE. That's very low leverage, especially while building. That's the foundation for doing more later, isn't it?
It absolutely is. And achieving that low leverage while delivering strong returns on the capital they already have deployed, that's the sign of really good management.
What were the returns like?
They delivered a healthy 15% return on capital employed, ROCE, during the first half of the year. And remember, ROCE measures how well a company uses all its capital, debt, and equity to generate profits.
Right.
Getting 15% while you're navigating a massive new project commissioning, that's a strong testament to their capital management skills, I'd say.
Yeah, it definitely sounds like their existing operations are incredibly disciplined. And that financial discipline, well, that's exactly what lets them make these big, ambitious bets, like really pushing exports and building that brand new facility. So let's look at that strategic engine, their geographic diversification.
Yeah, the source material really highlights this a powerful feature of VCL, a highly balanced sales mix. It's almost perfectly 50-50, 49% domestic sales, 51% exports.
That kind of balance, it minimizes risk, right, if one region slows down.
Exactly. It minimizes exposure to, localized economic downturns. It ensures they're plugged into global demand cycles wherever they happen to be strong at that moment.
And it looks like the global engine was firing on all cylinders in Q2. The consolidated export revenues saw a massive leap, quarter over quarter. This wasn't just a small increase, was it? It was a jump.
Oh, yeah. It was a 30% jump, quarter over quarter. Export revenues went from 157 crore in Q1 FY26 up to a record 105 crore in Q2 FY26.
30% growth in just 3 months at that scale.
It's tough to achieve, yeah. It suggests they're really successfully penetrating key international markets, probably driven by, competitive pricing, good quality product, reliable delivery, the whole package.
So when you pull it all together, the global reach, the high execution we're seeing, the financial discipline, it really seems to confirm what the management is saying about their overall strategy.
It really does. The chairman, Krishnamurthy Treat, he directly attributed this strong performance and that milestone revenue to 3 key pillars, he said. Strength of diversification, good demand for our products, and crucially efficient cost management.
And the numbers we just talked about, they're basically the proof points for those pillars.
Precisely. They're the statistical evidence that those strategic pillars are actually holding up the entire structure and holding it up well.
Okay, let's pivot now. Let's talk about the physical evidence of that diversification strategy.
Wow.
The new specialty chemical plant. This is the company really making a firm commitment to future growth beyond just their traditional core of chromium and barium chemicals.
Right. And this is, for me anyway, maybe the most exciting part of the release. This new asset, it's dedicated to making a specialized product called strontium carbonate. And operations successfully kicked off on August 20th, 2025.
August 20th. Okay, so it's very recent. Where is this plant located?
At their Visakhapatnam facility.
Okay. And what kind of scale are we talking about here? Is this like a small side project, or is this a significant strategic asset for them?
Oh, this is a major play. The installed capacity is approximately 17,000 tons per annum, TPA.
17,000 tons a year. That sounds like a lot.
It is. It immediately places them as a significant domestic producer. And it substantially strengthens VCL's long-term competitive position in the, broader specialty chemical segment.
So for you, the listener, what exactly is strontium carbonate? And why is VCL making it domestically such a big deal for the Indian market specifically?
What's fascinating here is the sort of national economic context. Strontium carbonate, historically, it was largely import-dependent in India.
Ah, okay. So most of it was coming from overseas?
Right. So VCL setting up this massive 17,000 TPA facility It's a really key step towards what they call import substitution. It reduces the reliance of Indian manufacturers on potentially volatile international supply chains, foreign exchange risks, all that stuff.
Got it. So if they're reducing import reliance, where is this chemical actually used? Like what end products are going to benefit from this new domestic supply?
The applications are pretty high-tech, actually, and essential. When you think strontium carbonate, think things like high-tech screens, sophisticated magnets.
Magnets like in speakers and motors.
Exactly. Those kinds of permanent magnets, also various advanced electronics, specialty ceramics, and it's also a key component in zinc electrolysis. So they're positioning themselves not just in old-school industry, but really at the cutting edge of domestic manufacturing needs.
That 17,000 TKA capacity. That sounds even more significant when you think about the global demand picture for this chemical.
Absolutely, and this is key. VCL is commissioning this new plant right in the epicenter of global demand. The Asia-Pacific region, APAC, accounts for a staggering amount, over 75% of global strontium carbonate demand.
Wow, 3/4 of the world's demand is in this region.
Yeah. Europe and North America follow, each with, over 20% market share, roughly. So by building this large domestic capacity, VCL is strategically aligning itself perfectly with that massive structural demand growth right here in the APAC region.
Okay, now building a new plant is one thing. Hugely impressive execution. But you've got to feed the beast, right? Securing your inputs for that plant and for the existing business, that's another challenge altogether.
Mm-hmm.
And that brings us to that strategic update that sometimes gets buried in these reports, the South Africa acquisition.
Yeah, this point, I think, needs way more attention because it addresses probably the single biggest risk factor for any chemical company.
Yeah.
Shocks to your raw material supply. VCL noted they are progressing steadily on the South Africa acquisition.
Okay, why is this such a big deal? And why go for a full acquisition instead of, say, just signing a long-term supply contract? Wouldn't that be easier?
Well, maybe easier in the short term, but in the chromium and barium space particularly, controlling the source of your key raw materials.
Yeah.
That's basically controlling your destiny. An acquisition, especially in a resource-rich area like South Africa, it gives you vertical integration.
Meaning they own the mine or access to it?
Potentially, yes, or a significant stake. It insulates you from global supply price swings, geopolitical instability, potential supplier cartels. Long-term contracts, they can be broken. They can be repriced at renewal. Ownership offers true long-term raw material security.
So this acquisition, it's essentially like an insurance policy for their huge existing operations, ensuring they can keep that, 43% gross margin, even if global input costs go crazy.
That's exactly right. It's a strategic hedge. It shows you have a management team that's thinking several years down the road. They're saying, look, we've achieved efficiency today, but to guarantee consistency tomorrow, we need to lock in our supply chain.
Right.
This move helps ensure they can actually capitalize on that new strontium carbonate capacity without constantly worrying about input cost instability blowing up their margins.
It really does seem like execution is the defining word for this entire reporting period. From, keeping the balance sheet tight to actually building the plan and now managing the supply chain risk proactively.
Yeah, that continuity, that competence. It was highlighted by the joint managing director, Siddhartha Q. He explicitly mentioned the company's consistent performance and project execution abilities as being the foundation for their strong operational fundamentals.
So they're not just reporting good numbers, they're actually delivering on major, complex structural projects at the same time.
Exactly. It's the combination that's impressive.
Fantastic. Okay, let's try and synthesize the key takeaways for you, the listener. VCL's Q2 FY26. It was really defined by hitting 3 major milestones all at once. First, breaking that crucial 400 crore revenue ceiling.
Yep.
Second, showing exceptional profitability, that 44% PKT growth driven by operational leverage. And third, successfully executing a major diversification move into strontium carbonate production with that new 17,000 TPA facility. And crucially, beneath all that, they're strategically securing their future growth path by keeping a strong balance sheet and making moves on that South Africa raw material acquisition.
Yeah, and this raises, I think, an important final question for you to ponder, particularly about that new strontium carbonate facility and its place in the global market. Given that Asia-Pacific accounts for over 3/4 of the global demand,
Right.
and considering VCL's proven track record now of efficient execution, their global export strength, How quickly might this new 17,000 TPA domestic facility start to potentially displace established international suppliers? Could it actually reshape regional trade flows and the competitive dynamics in this specialized market?
That's a great point. That much new capacity coming online, right in the heart of the demand region, incumbent players will definitely have to react somehow.
Exactly. That capacity is going to demand a swift response. It'll be fascinating to watch.
It certainly will. That is definitely something to keep an eye on as VCL ramps up production through the rest of this fiscal year. Thank you for joining us for the deep dive.
Thanks for listening.
We'll catch you next time.